Welcome, everyone. Today we're diving into an absolutely fascinating earnings report from CNXN, ticker symbol CNXN. Now, you might be wondering why this one stands out. Well, for Q2 2026, the data is throwing off some incredibly contrasting signals. On one hand, we're seeing this explosive breakout top-line revenue growth, but right alongside it, some pretty severe, frankly puzzling, cash flow deterioration. So we're going to do a comprehensive deep dive explainer on exactly what is happening beneath the surface of this Fortune 1000 IT solutions provider. It's like a giant financial puzzle, and we're going to put the pieces together.
Okay, let's dive into this. Here's our roadmap for the explainer today. We'll kick things off with Section 1, the Q2 2026 breakout. Then we'll weigh the arguments with Section 2, the bull case, and Section 3, the bear case. After that, we'll look at the hard numbers in Section 4, fundamentals and valuation, and wrap it all up with Section 5, market sentiment and momentum. Section 1, the Q2 2026 breakout, record-breaking top-line results. You know, for the better part of a year, CNXN was facing some real top-line stagnation. But this quarter, they completely flipped the script.
Net sales came in at a staggering $854 million, literally a massive 12.4% jump year over year. To put that into perspective, Wall Street analysts were only expecting about $767 million. So CNXN didn't just beat those estimates, they blew past them by more than 11%. This effectively signals that their dreaded period of stagnation is finally in the rearview mirror.
And here's the best part. They didn't just grow revenue, they proved they could do it profitably. Adjusted earnings per share hit $1.31. That's a massive 26% beat over analyst consensus and a huge 35% jump from the 97 cents they reported in the exact same quarter last year. It's absolutely crucial to note that their cost reduction initiatives from late 2025 are clearly paying off right now. It's giving them some fantastic operating leverage.
Let's look at what leadership thinks. As CEO Timothy McGrath noted in the earnings release, our record financial performance reflects more than strong execution, it reflects the value that our customers are placing on their enterprise technology. What management is really signaling here is a fundamental shift in the market. Organizations are no longer just kind of experimenting with AI, they're actively moving into full-scale, enterprise-wide deployments and aggressively upgrading their hardware to support it all.
Section 2, the bull case. Commercial engines firing on all cylinders. When we look at the underlying segment data, it strongly supports this idea that a massive, AI-driven PC refresh cycle has finally hit escape velocity.
And this brilliantly illustrates exactly where that demand is coming from. Notebooks and mobility make up 40% of sales, and desktops are pulling in 11%. Combined, these endpoint devices surged 19% year over year and now account for a whopping 51% of all net sales. More than half. This basically proves that businesses are actively pulling the trigger on upgrading their workforce's daily hardware for the Windows 11 and AI era.
Let's break down how this builds across their specific customer segments. Honestly, the commercial engines are just firing on all cylinders here. Business Solutions, which primarily serve small and medium-sized businesses, saw an aggressive 17.3% growth. Enterprise Solutions maintained a super strong double-digit growth rate of 13.4%. They are absolutely winning major deals in the commercial space right now.
Now, interestingly, the public sector came in at exactly 0% growth, flat. But believe it or not, this flatlining is actually a huge win for the bull case. For 4 consecutive quarters prior to this, the public sector segment suffered severe double-digit declines, averaging negative 26%, mostly because they were lapping a massive lost federal project. By hitting 0%, the bleeding has finally stopped. The public sector albatross has effectively been removed from their consolidated growth numbers.
Section 3, the bear case. Profitability versus cash flow divergence. Now, before we get too carried away with the hype, we really need to look deeply beneath those shiny top-line revenue numbers, because frankly, there are some serious red flags hidden in the cash flow statements.
Yes, they had a record quarter for sales, and yes, net income was up 33.8%. But that begs a very uncomfortable question. How can a company with record profits suddenly be burning through cash?
Now, what's really interesting about this slide is the violent divergence between the two metrics here. CNXN reported $33.2 million in net income, yet their operating cash flow completely collapsed to negative $63.8 million. That is an enormous gap. It essentially means the profits they are claiming on paper aren't actually materializing in the company's bank account right now.
So let's unpack this mystery. Why the massive cash drain? First off, accounts receivable spiked by almost $67 million, pushing their days sales outstanding up to 71 days. This suggests Connection is extending very generous credit terms to win these deals, or maybe the sales were just heavily weighted to the very end of the quarter. Second, there's a real risk that customers are pulling forward orders due to global memory shortages, meaning they're buying today just to avoid price hikes tomorrow, which could leave a dangerous demand air pocket next quarter. Finally, despite that great 17.3% growth in business solutions we talked about, margins actually compressed by 50 basis points. They are sacrificing profitability to aggressively capture market share in the SMB space.
And there is one more major red flag for the bears. Management has consistently talked up data center modernization as a core growth pillar. Yet server and storage sales plummeted 18% year over year, dropping from 9% down to 7% of total sales. This directly contradicts their own narrative. While they are clearly winning the laptop upgrades, they seem to be losing out on the higher-value enterprise infrastructure deals, perhaps losing ground to competitors or direct cloud providers.
Section 4. Fundamentals and Valuation. A fortress balance sheet. Despite the totally valid cash flow and margin concerns we just discussed, we have to admit the underlying financial stability of PC Connection remains incredibly robust.
Let's look at the key metrics here as analysts. They are currently trading at a trailing PE of 21.35, but a forward PE of 18.65. This implies the market absolutely expects continued profitable growth. The PEG ratio, which factors in that growth rate, sits at a very reasonable 1.85. And an EV to EBITDA of 13.18 shows a valuation that is quite standard for a healthy, mid-cap business services company. Plus, they are generating a solid 10.43% return on equity.
But here is the real strength of the company, their fortress-like balance sheet. They hold a massive $340.7 million in cash and short-term investments against a microscopic $7.55 million in total debt. That leaves them with a net cash position of over $333 million. This provides a huge margin of safety, heavily insulating them from interest rate risks or any short-term economic shocks.
And because of that incredibly strong cash position, management is committed to returning capital to shareholders. They pay an annual dividend of 80 cents per share, which currently yields about 0.99%. Plus, they still have over $81 million remaining in their stock repurchase program, giving them plenty of ammunition and flexibility to support the stock price going forward.
Section 5. Market Sentiment and Momentum, Riding the AI Wave. So, with the bulls cheering the top-line growth and the bears pointing to the cash flow divergence, how is Wall Street actually reacting? Well, the short answer is, they're riding the AI wave.
Connection stock has significantly outperformed the broader market. Over the last year, CNXN is up 37.24%, easily crushing the S&P 500's return of 23.52% over that exact same period. The market is clearly rewarding their much-anticipated return to double-digit growth.
Institutional sentiment leans heavily toward the bull case right now for sure. Connection currently holds a Zacks rank of number 1, which is a strong buy, paired with a solid momentum style score of B. Analysts have been consistently revising their earnings estimates upward over the past 60 days, and the stock is trading right near the very top of its 52-week range. So the crucial point is summarized perfectly by Zacks Investment Research right here. Given these factors, it shouldn't be surprising that CNXN is a number 1 strong buy stock. If you're looking for a fresh pick that's set to soar in the near term, make sure to keep PC Connection on your short list. In short, Wall Street's momentum outlook is overwhelmingly positive.
But that leaves us with one final, very provocative question to consider. With those severe cash flow drains and highly extended payment terms we discussed, will this AI PC refresh cycle actually sustain its momentum into the second half of the year? Or is this impressive Q2 growth simply demand borrowed from the future due to global hardware shortages? That is the multi-million-dollar question that makes Connection's next earnings report an absolute must-watch. Thanks for learning with us today on This Explainer, and keep your eyes on the data.